Monetary
guys.
rate has
Do you know
been
that monetary
reduced. The
policy
joy
rate has
and the
been reduced?
pain.
Okay, so Bank of Ghana have reduced monetary policy rate from 18% to 15.5%. And what is monetary policy rate? The monetary policy is actually a benchmark for all interest, all forms of interest in an economy. So it affects interest for loan, it affects interest for on investment, okay, investments. So when it reduces, it has a double side effect. So yes, the cost of borrowing is going to reduce. So that is why in February 4th, the new Ghana reference rate that came, it has been reduced from 15.68% to 14.58%. Now, what is Ghana reference rate? Ghana reference is a rate that is given by Bank of Ghana to as a benchmark, which affects the interest, the lending rate that is given by banks. Okay, so yes, monetary rate reducing is going as reduce the cost of borrowing. So by now, every bank should have reduced the cost of borrowing, interest on loans. It should have been reduced, and it's a joyful thing because it's going to encourage businesses to borrow, like SMEs will be able to borrow at a lower cost. Household who probably needs things but are afraid to go and borrow because the cost of borrowing is high can now go and borrow and consume whatever they want to consume. And over all purpose for which government want to government have reduced, or Bank of Ghana have reduced policy rate, is to encourage economic activities. Okay, it wants money to be in the system to encourage businesses, to encourage consumption. Okay, and so by so doing, cost of borrowing has gone down, and yes, cost of borrowing in various banks should be down by now. Now let's look at, that is the joyful aspect. Let's look at the painful aspect. Okay, the painful aspect now is that we are going to get low interest on our savings, on our fixed income. The fixed income investment we do, like fixed deposit and even treasury, is going to affect them. So meaning that they are discouraging saving. It is going to discourage saving. Let me not say they are. It's going to discourage saving. It's going to discourage investment in fixed deposit, because now if you go for fixed deposit, when the monetary rate has been reduced, you are going to get less. Yeah, you are going to get less, and it's probably going to discourage you from investing in these things, fixed deposit in treasury gold. Well, what this is eventually going to do is that it's going to encourage excessive spending. Why? Now, if people are discouraged from investing their excess money, you know, if you are not doing anything, if you don't have any money to invest, any business to invest in it, the excess money you have that you are keeping there, you are not motivated to invest, but whatever you're going to earn on the interest they are giving to you is quite discouraging to you. What is going to happen? You'll be having the money, and meaning you are going to spend, but there is liquidity. Okay, there is liquidity. The money is available, the cash is available with you, or just lying there in your bank, so you can easily get access to it. Okay, so it's going to encourage spending, and if not managed well, it's going to cause inflation. So we have two sides of monetary rates. The positive side is lowering the cost of borrowing, and as is shown in the Ghana reference rate, and discouraging savings, certain savings, discouraging savings and fixed income investment. So all right, so even though it's going to, the rates for fixed deposit, treasury bill, and all forms of investment in various financial institutions are going to be, the interests are going to be very low. It doesn't justify you not investing. If you have any excess income there, it's better you earn little on it than it's better to earn little than to leave it in your account just like that. Okay, so or spending it unnecessary. So no matter what happens, savings, no matter what happens, investment is key. Investing your excess income in to get a little passive income is so key. Thank you.